Something important is unfolding right now, and the world's largest banks are quietly telling their richest clients about it through private research notes. But almost none of that information is reaching the people who need to understand it most. Goldman Sachs, UBS, JP Morgan. Within just 48 hours, all three released research pointing toward the same direction, the same asset, the same structural change, and the same conclusion about where the global monetary system is heading and what that means for the purchasing power of every dollar, euro, and pound that ordinary people have spent their lives saving. I have those reports. I have gone through them carefully from beginning to end. And over the next 20 minutes, what I want to do is translate what they are really saying, not summarize it, not cherry-pick the comforting parts, but explain clearly what these institutions are telling their biggest clients, why it matters directly to you, and what the combination of central bank behavior, institutional positioning, and sovereign policy shifts reveals about the monetary reset that is already in motion. Let me begin with the most important word in the title, devaluation. Because devaluation is one of the most important economic concepts in the modern world, and almost nobody truly understands it until it has already happened to them. Devaluation does not need a dramatic announcement. It does not need a screaming crisis headline. It does not need a stock market crash. It happens quietly. It happens gradually. And it happens to anyone who stores their wealth in something that can be created in unlimited quantities. Your savings account might pay 4%. If you are using one of the large retail banks, it may be closer to 1%. Meanwhile, official consumer inflation is running at roughly 5% a year. That means in real terms, in terms of what your money can actually buy, you are losing purchasing power month after month. Not because the market collapsed, not because you made some terrible decision, but because the system itself is designed to transfer purchasing power away from savers and toward borrowers. And the biggest borrower in the world is the government issuing the currency you are saving in. This is not a new idea, but it has now reached a new level of urgency. And the reason it has reached that urgency is visible in what Goldman Sachs, UBS, and the world's central banks are doing with their own capital. Not what they say in public, but what they actually do. Let me begin with Goldman Sachs, because their position is the most direct. Goldman Sachs is the most influential investment bank in the world when it comes to institutional capital flows. When senior Goldman commodity analysts publish a note describing their stance on an asset as constructive, which in institutional language means bullish, meaning they believe prices are likely to move higher, that language moves capital. Funds react, positions change, allocations shift, and when Goldman uses the word constructive in a research note published after a 12% monthly decline in an asset, what that really means is very simple. The sell-off did not change our view. We are still buyers. That is what they said about gold after its worst monthly performance in 13 years. After a drop that many retail investors interpreted as proof that the gold thesis was over. Goldman's analysts tied that bullish view to three main factors. First, continued inflation pressure driven by the Middle East conflict and rising energy prices. Second, the Federal Reserve's limited ability to cut rates aggressively in that inflationary environment. And third, the long-term fiscal path of the United States government, which is spending money it does not have at a pace with almost no peacetime historical precedent. That fiscal point matters most because it sits underneath everything else. The United States government now carries national debt above $38 trillion. Its annual deficit, the gap between what it spends and what it collects in taxes each year, is running at around $2 trillion. And the interest being paid on existing debt has now risen above the entire defense budget. This is not some distant future problem. It is a current reality. And it creates a constraint that will ultimately shape everything monetary policy is forced to do. When a government spends much more than it collects, it has only two basic ways to close that gap. The first is borrowing, issuing debt and paying interest to those willing to buy it. The second is monetization, effectively having the central bank create money to buy government debt. In plain language, that means printing money. The first option works only as long as interest costs remain manageable relative to government revenue. But once that burden grows too large, and it already has, the government faces a choice. Either accept painful fiscal tightening that is politically unacceptable, or use monetary accommodation and gradually erode the value of the currency. Every major developed government is choosing the second option. They are choosing inflation over austerity. And they will keep choosing it, because the political cost of the alternative is too high for elected officials. That is why Goldman Sachs remains constructive on gold after a 12% decline, not because of a short-term trade, but because of an arithmetic reality that cannot be solved without a prolonged period of currency debasement. And that, in precise terms, is what this video means by devaluation. Now let's turn to UBS, because the Swiss view adds an important layer to the Goldman thesis. UBS identifies four main drivers for gold in the current environment, and together, those four drivers create a clear picture of the structural forces now in motion. The first is stagflation risk. Stagflation is the condition where prices rise while growth slows. In other words, the worst combination possible. You get inflation, but without the economic expansion that would normally make it easier to live with. It is the exact environment the Federal Reserve is least equipped to deal with because its main tool, interest rate policy, works against one problem while making the other worse. Cut rates to support growth and inflation rises faster. Raise rates to control inflation and growth weakens even more. The central bank becomes trapped. And in every major stagflationary episode in modern history, especially in the 1970s, the clearest example, gold has been one of the strongest performing assets precisely because it exists outside the monetary system that is failing to preserve price stability. UBS is explicitly warning that stagflation is a serious and underpriced risk in the current environment. That risk is being driven by energy pressures linked to the Middle East conflict, along with structural growth headwinds caused by tariffs, geopolitical fragmentation, and tightening credit conditions. The second driver UBS highlights is dollar weakness. For decades, the dollar's reserve premium, the extra global demand for dollars beyond what U.S. economic fundamentals alone would justify, has been one of the main forces holding gold back. When the dollar is strong, gold becomes more expensive for non-dollar buyers, which reduces global demand. When the dollar weakens, gold becomes cheaper for most of the world's population, and demand broadens. UBS's medium-term view is that the dollar is likely to weaken from current levels. Why? Because of the same fiscal reality already discussed: persistent deficits, growing monetization risk, and a slow but meaningful erosion of trust in the dollar's reserve status, especially as sovereign countries watch dollar-based assets being used as geopolitical tools, such as in the case of Russian reserves, and begin drawing their own conclusions about the risks of dollar dependency. The dollar does not need to collapse for this to matter. A slow, steady weakening over several years, the kind that does not produce dramatic headlines but constantly reduces purchasing power, is enough to create a powerful structural tailwind for gold. The third driver is lower interest rates. At first glance, this may sound counterintuitive because the Federal Reserve is currently constrained from cutting rates aggressively due to inflation. But UBS is not making a short-term argument, it is making a medium-term one. The debt arithmetic matters again here. A $38 trillion debt load, expanding deficits, and interest payments that already exceed the defense budget create a situation where sustained high rates cannot be maintained forever. At some point, the interest burden becomes economically and politically intolerable. And when that happens, the Fed will face overwhelming pressure to cut rates, even if inflation remains elevated. When rates fall in that environment, real yields on dollar assets fall as well. And when real yields decline, the opportunity cost of owning gold declines with them. That removes the main short-term argument against holding an asset that pays no coupon. The fourth driver, and the most structurally important one, is central bank buying. According to the World Gold Council, central banks purchased more than 1,000 tons of gold last year. That was not some isolated anomaly. It was part of a trend that has been building since around 2010 and has accelerated significantly since 2022. Gold now makes up roughly 20% of emerging market central bank reserves, a level that would have looked unrealistic just a decade ago. And these central banks are not buying because they think gold might produce a nice return. They are buying because they are reducing exposure to a reserve system that has shown, through the freezing of Russian assets, that it can be shaped by political discretion rather than neutral rules. This is the deepest and most durable part of the gold thesis. The dollar's reserve status was built on trust. The trust that U.S. institutions would honor obligations to foreign holders of dollar assets regardless of political relationships. That trust has been structurally weakened, and once that kind of precedent is set, it cannot be fully repaired with one policy statement or one diplomatic gesture. Every sovereign treasury and central bank in the world has updated its risk calculations accordingly. Now let me address something that matters for anyone trying to understand recent gold price action. Gold just suffered its worst monthly decline in 13 years. If you own gold, you felt that drawdown. And the obvious question is, does this change the thesis? Is the 12% drop telling you something Goldman Sachs and UBS are missing? To answer that, you need to understand why the decline happened, not the headline explanation. The actual mechanism. The decline was a liquidity event, not a fundamental reassessment of gold's value. Here is what happened. The Middle East conflict drove oil prices sharply higher. That created mark-to-market losses across nearly every major asset class except energy. Hedge funds, many of which operate with heavy leverage, sometimes up to 40 times equity capital, began receiving margin calls across their portfolios. And when you are leveraged 40 to 1, even a relatively small adverse move can become catastrophic relative to your equity. You need cash immediately. And when you need cash immediately, you do not sell what you most want to sell. You sell what you can sell fast. You sell what the market can absorb in size. Gold is one of the most liquid assets in the world. It can be sold instantly, in scale, around the clock, in nearly every time zone. So leveraged funds sold gold not because they believed it was fundamentally overvalued, but because it was the quickest source of liquidity during a period of acute portfolio stress. The best analogy is this. If a homeowner loses their job, they do not sell the house because the house suddenly became a bad investment. They sell it because they need cash. The house itself may not have changed at all. Its location, its quality, its long-term value may be exactly the same. What changed was the seller's liquidity position. Gold was that house. The institutions selling it were not expressing a long-term view on gold. They were responding to an immediate cash need. And the evidence supporting this interpretation can be seen in the physical market. During the same period when paper gold prices were falling, when COMEX futures were being sold aggressively by leveraged participants, the registered inventory of physical gold in COMEX vaults was also falling. Physical gold was leaving the system. Delivery demand remained elevated. If the selling had reflected a true fundamental reassessment of gold, you would expect physical demand to weaken too. But that is not what happened. Instead, the buyers of physical gold, the people who want real metal, not just paper exposure, increased their buying at lower prices. The paper market and the physical market were telling completely different stories. The paper market was saying panic. The physical market was saying opportunity. That divergence between paper and physical is one of the most reliable signals in the gold market. And historically, it means one thing. The paper market is temporarily mispricing the asset relative to underlying physical demand. That kind of disconnect does not last forever. Eventually, the physical market reasserts itself. Now let's move to China, because this may be the most structurally important development in the gold market, and Western financial media has largely ignored it. Chinese regulators recently approved a program allowing 10 major insurance companies, including PICC and China Life, institutions that manage assets worth trillions of renminbi, to allocate up to 1% of their total assets into gold. UBS analysts traveled to China to study this development directly. What they found was significant. Chinese gold ETF inflows remained strong during the same period when North American ETF flows were heavily negative. Trading volumes on the Shanghai Gold Exchange increased. And the insurance company allocation program has not yet reached its approved limit, which means the capital already authorized to move into gold has not yet fully entered the market. Just 1% of the assets managed by China's major insurance firms represents around $27 billion US dollars of potential gold buying, and that number is likely conservative. The program may later be expanded to more institutions. The allocation cap itself may also rise if the pilot continues to work. This is not short-term speculative money. Insurance companies are some of the longest duration investors in any financial system. They think in decades. When they build a gold allocation, they do not dump it because of one bad month. They hold it. They add to it. And that kind of long-duration physical demand is exactly the kind of force that short-term paper market volatility cannot suppress forever. What is happening here is clear. Western paper holders are selling. Eastern physical buyers are accumulating. Gold is moving from leveraged short-term hands into unleveraged long-term hands. And every time that transfer happens, two things become more true. The pool of gold available for forced selling becomes smaller, and the base of committed long-term holders becomes larger. The implications for future price behavior are obvious. Now, let me give you the three most useful analytical questions for judging any asset in this environment. Not just gold, but any serious capital allocation decision. The first question is this: what are the most well-resourced institutions in the world actually doing with their money, as opposed to what they are saying publicly? Words and actions often diverge. Public statements are often designed to shape perception. Actual capital allocation reflects genuine conviction. And right now, the answer is unmistakable. Central banks are buying gold at the strongest sustained pace seen in decades. Chinese institutions are building the largest gold allocation in their history through a regulatory program that has received very little attention in the West. Goldman Sachs remains constructive on gold even after a 12% drop. UBS is telling clients to stay bullish. These are not vague opinions. These are published institutional research views and observable capital allocation trends. And when institutions with the deepest research resources and the longest time horizons all begin converging on the same asset, that deserves very serious attention. The second question is, what is the crowd doing, and what does that reveal about where we are in the sentiment cycle? Retail investors sold both equities and gold aggressively during the most intense phase of the recent crisis. Sentiment readings reached deeply bearish extremes. That matters not because retail sentiment always predicts direction perfectly, but because extreme positioning creates the setup for the next move. Once most of the people who are going to sell have already sold, the next move is often determined by the marginal buyer. And in this case, the marginal buyers are the institutions waiting for exactly this kind of liquidity-driven dislocation to build positions at distressed prices. JP Morgan's own data shows that when U.S. equity positioning has been as bearish as it is now, the S&P 500 has historically produced an average gain of roughly 8.2% over the following 3 months. That is not a guarantee, it is a historical average. But it reflects a very important market reality. Maximum pessimism and maximum opportunity often appear together. The third question is, are the forces behind this thesis temporary or are they long-term, and are they likely to strengthen or fade over the coming years? The structural drivers behind the gold thesis, fiscal excess, monetary debasement, de-dollarization, and reserve diversification, are not short-term cycles. They are not the result of a single policy mistake, and they will not disappear because of one policy adjustment. The U.S. fiscal deficit reflects deep structural spending obligations and revenue constraints that have been developing for decades. The de-dollarization trend reflects a geopolitical reality, the weaponization of dollar assets, that cannot be reversed by symbolic diplomacy. The Chinese insurance allocation program reflects a regulatory shift that can continue compounding over years as it matures and expands. These are all multi-year forces, and they are all moving in the same direction. They reinforce each other. The reset already underway is not primarily a market event, it is a monetary event. It is the slow, sustained devaluation of fiat currency relative to scarce physical assets. That is the mechanism governments use to deal with the contradiction between massive debt obligations and their unwillingness or inability to cut spending meaningfully. This has happened before. It is visible across the historical record of every major fiat currency over long enough time periods. And the institutions that understand this process are already positioning for it quietly, systematically, and at the prices created by short-term volatility. The people who get damaged in a monetary reset are not usually the ones who picked the wrong stock. They are the ones who kept their wealth inside the asset being devalued: cash, fixed income, savings accounts, while the institutions that understood what was happening quietly shifted their capital into assets that preserved purchasing power through the debasement cycle. Understanding the mechanism is the first step to making sure you are not on the wrong side of it. Dalio Marco Mind.